Hello, welcome to week 4 of financial economics. Let me share my screen. Okay, we are going to talk about equities today, which, as I have mentioned, is by far the most important part of financial markets in terms of investments, in terms of ease of understanding, also in terms of the research and consulting work that has been done in equities. As I have discussed earlier, equity is a very simple idea to understand. You start a business and you tell me that, hey, professor, why don't you buy 40% of my business at $100,000? That way I get 40% of the ownership rights, 40% of the rights to profits, etc. However, as we discussed last week, equity is also the junior most in terms of the fact that if the firm does go bankrupt, then the equity holders are the last in line after various kinds of seniority, equity, preferred equity, debt, senior debt, then fees payable to lawyers, etc., and so on. Okay, so all of that. So today we are going to kind of really sink our teeth into some modeling. And one of the things that I really would like to emphasize to you that in this course, we don't do stylized facts. I don't make up numbers. I don't give you examples which are not based in reality. We only work with real data. As W. Edward Deming so famously said, in God we trust. Everyone else must bring data. And that's what we are going to do. We're going to be extremely rigorous, extremely quantitative, but the fact of the matter is finance is the study of the real world. It's not just theories. And that's what is going to be a focus. Having said that, however, we are going to look at some models, and some of which are simple, and simplicity is an important aspect, but we will also make sure we understand the limitations of our theories. And so you must always keep in mind that a model is only as good as the assumptions that go into it. So if the assumptions don't hold, then the conclusions don't hold either. Having said that, in the absence of a model, reality is just way too complicated to do anything with it. So we need to have models, which are by definitions simplifications, where we take what we think is essential to a particular situation and throw out the ones that we think are unnecessary details. And that's where models are different. Different models have different focuses and will give you different results. And that's absolutely fine. But the point is, ignoring that is never a good idea. What one absolutely must do is be aware of the limitations of any particular model. So some of the models, particularly the capital asset pricing model, the market model, which we will do next week, which are primarily applied to equities, and we will introduce all of that in the context of equities, have some strong assumptions. The first assumption is, for instance, identical investors. In particular, the two prongs to investors being identical. They have the same information, which means they have the same expectation, covariance, etc., the same, all the same summary statistics and all of that stuff, and the same identical attitude to risk, i.e. the same utility function. Why are the two different? Identical information is where you have the same information, but the identical attitude to risk is a bit more than that. And this is the idea of difference between private value and a public value. So for instance, you and I can have different information about the same objective, about the same security, about the same firm, about the same real estate property, everything. That's the idea of that, where we can have different information, which is private information, but public value. The other is where you and I just have different valuations because of our own private valuation of the project. of the security, of the asset, which is not the same thing as difference in information, but common value. It is where we have different valuations altogether. And that can happen in the particular context of finance when investors have different attitudes to risk. So those are the two things we have abstracted from and said identical investors are here, identical. And those are the two prongs of that particular assumption. All right. We're going to define this idea of the excess return for an investment is the return on that investment minus the rate of return on a risk-free investment. What is that risk-free investment, which we will talk about, which we alluded to in the last couple of weeks, but we will discuss in more detail shortly. But the point is, if there is such a risk-free rate, then the excess return is the return on that investment over and above what the risk-free rate is. I mean, the idea is very straightforward. If you have different, it's particularly useful in comparing across time periods. So for instance, in let's take January 2009 versus January 2019, a 10-year difference, where in January 2009, an asset which did not carry any risk would get almost zero return. Whereas in January 2019, 10 years later, a risk-free asset would get a return of about 2%. We will look at these data in a lot of detail when we do fixed income securities. And the point to be made is anytime we talk about the return of an investment, we need to understand how much over and above the risk-free rate that particular investment is. So because the idea is that an investor is compensated for bearing risk. So so whatever the risk-free rate is, whatever the rate of return that would be obtainable if there were no risk, then that has to be subtracted away from that return. That's the idea of considering the excess return of an investment. And the risk premium, which we discussed last week, is the expected excess return. What is the average excess return of a security over the relevant time period, etc. Risk of an investment is the standard deviation of the return. All right. Now, we talked about this earlier that for a financial economist, we always say more the return, the better. The more the risk, the worse. Return is a good thing. Risk is a bad thing. How do you trade them off? And we have talked about various utility functions, which are just risk preference functions for different investors, for the same investor in different time periods, etc. But we also talked about in specific about the quadratic utility function, which has a particular functional form and which we will spend a lot of time today on walking through and working through. But once again, the higher the return, the better off you are. The higher the volatility, the worse off you are. So those two are working in opposite directions. So the first very linear approximation of that trade-off is to say, hey, let's just take the ratio of the two. Nobel Prize winning work, Sharpe ratio is risk premium divided by risk. And that anytime you are asked to evaluate a security or an asset or a project, first thing you should do is to calculate the Sharpe ratio. All right, because higher the Sharpe ratio, the better that particular security is, according to this somewhat simplistic measure, but it's a very good starting point. And what does it measure? As a ratio, for instance, it's risk premium divided by risk. So for every 1% additional risk, how much additional excess return are you getting? So if the Sharpe ratio is, for instance, let's say 0.3, then that means for every 1% increase in risk, you will get 0.3% increase in the excess return of that security. Okay, so once again, it's a ratio, it's a simple measure, but it captures the idea of the trade-off between the two. Simple first approximation, first linear approximation, which we will talk a great deal more about later. Now, this identical investors is a, is a is a large simplification, all right? And what we see is that many textbooks, for instance, will often talk about this much simplified. Hang on just a second. Yeah, simplified version of the world, of the financial world. The thing to keep in mind, and I'm going to talk about this a little bit, and later on we'll talk much more about it, is that identical investors is hugely problematic in the following sense. If you and I value the particular security in exactly the same way, then there is absolutely no reason to have a trade. The only reason you would have a trade, or you and I would trade, is if you valued a security at $200 and I valued the security at $200.10. In that case, there is a gain to trade. It's only because of heterogeneity, because of dispersion of investor valuations, that we have any trade whatsoever. So trading volume is one of those really, really misunderstood concepts in finance. And later on, when we do market efficiency, we will talk about some of my research. In fact, it's talked about in your textbook as well, where we see that investor valuation dispersion is what causes trading volume. That's got almost nothing to do with whether the market is efficient, market values things correctly or anything. It's a different matter altogether. But the thing is, if there is no heterogeneity, then there is no trade. So for the time being, we're talking about identical investors. So we are abstracting away from that very important aspect. But we will put that back into the picture later on. All right, so as we said, the risk idea of a risk-free rate is critical to understanding excess return. How much of the return on an investment is over and above what would be attained if there were no risk taken by the owner of that security. So is there such a risk-free rate of return? So the assumption here is that there exists such a well-understood risk-free rate of return that serves as the certainty equivalent for any investment under consideration. We typically choose the T-bill, the treasury bill, for approximately the same maturity as the investment under consideration. So we talked about this. We downloaded data last week. We saw that, and we will do this in much more detail when we do fixed income securities. The US government borrows money on a regular basis. And the borrowing instruments are what are called T-bills, T-bonds, and so on and so forth, have various different properties. They're just in an incredibly complex portfolio. But the thing is, there is a fixed interest rate that is payable in some installments, and there is a certain level of maturity for each such T-bill or T-bond and so on. So, so in particular, what we say is if you are taking, let's say, a 1 month horizon, then you would look at the T-bill with 1 month maturity as the corresponding risk-free rate. If you are looking at an investment with a horizon of 10 years, then you would take a relevant federal government borrowing with 10-year maturity as the corresponding comparable risk-free security. Okay, all of that data is available from Federal Reserve, which we talked about, and we will get more into that in just a few minutes. Okay, why are they considered risk-free? And the reason is, since the creation of our union, the US federal government has never defaulted on its debt. Other countries have. Argentina just defaulted a few weeks ago on its debt. Russia has, Thailand has, and so on. The US federal government has never defaulted on its debt. Now, for those of you who have spent a lot of time in macroeconomics, you will know that sovereign debt has been modeled as, for instance, impossible to default on, because a sovereign country can always print money. But that's, remember, if it is denominated in its own currency. Okay, so when it is not denominated in its own currency, you can print money, yes, but that will only reduce the amount that you can pay. So it's a It's people will say sovereign debt is by definition default free. Not quite true. And what we have seen in the history of, let's say, the last 100 years is that many countries have defaulted on their debt. So that's just something to keep in mind. But the US government, US federal government has never defaulted. And so there is no default premium that is associated with any US federal government debt. We will once again, we'll talk about this default premium, that excess amount over and above that any borrower, whether it's an individual or a safe investor like Coca-Cola, or a more leveraged investor like Tesla, they will have different default premiums added on to their interest rates that they have to pay for their borrowing. Now, because the US has never defaulted on its debt, it is considered risk-free. And what happened, if you might remember, during the 2016 presidential elections is President Trump, who actually, because in his investment, because he has been a real estate businessman for a very long time, and defaulting in the private sector is frowned upon, but it's not unheard of. And so he, for instance, talked about quite flippantly about the US federal government debt as saying, what's the big deal? We'll default and renegotiate it. And a lot of us, the financial economists, were absolutely quite taken aback by this idea that one can just default on US debt and renegotiate it. For one thing, we were like, okay, what are we going to use as risk-free rates in the future? Granted, that's not a good enough reason for not defaulting upon one's debt. But anyway, I'm just kind of throwing all the facts out there as to why US federal government debt is still considered risk-free. Mind you, not all US state, local, municipal debts are considered risk-free. They're not. Because they can default. Puerto Rico's state, well, it's not a state, but its territory default, its government defaulted on its debt recently. So those things happen, but the US federal government hasn't, and that's why we consider US federal government debt to be risk-free. So we will then look at what we RFT, which is the monthly return on month T of a risk-free security. The relevant, if 1 month is the relevant horizon, then GS1M on the Federal Reserve database, which we downloaded last week, is the annualized return of that 1 month Treasury constant maturity percent. And then you have to take that annualized return in percent divided by 100 to get it into level. And then you divide it by 12 to get it into an arithmetic monthly rate. As you can see, it is, in principle, it should be done in the geometric way, as we see in the first equation. But the tiny numbers, they make practically no difference whether you do it arithmetic division or a geometric inverse compounding. All right. So having said that, I will actually make sure we are on board with understanding how the Sharpe ratio is calculated. So in particular, we are going to take these steps to look at the Sharpe ratio for a security. So for instance, in order to understand the Sharpe ratio for a particular security for a particular time period, we then need to download the monthly security returns for that security from CRISP on Words, as we did last week. And then you would estimate the volatility, which is the denominator of the Sharpe ratio, by calculating the standard deviation of monthly security returns over the relevant period. All right, so that takes care of the denominator. To take care of the numerator, you need to calculate the average security return and subtract from it the average risk-free return. Okay, that gives you the risk premium that we talked about. That is the numerator of the Sharpe ratio. So the Sharpe ratio of the security, therefore, is the average excess return of the security divided by the volatility of the security return. Now, there is a variant of the Sharpe ratio, which is not the Sharpe ratio. A variant of it is where we say, well, actually, let me step back for a second. The Sharpe ratio, as you can see, it's the average excess return for the security divided by the volatility of the security return. The numerator is dealing with excess return, whereas the denominator is dealing with the actual return. Excess return versus actual return. There, you can, for instance, change that and say, because the risk-free rate is typically absolutely tiny, you can say, okay, I'm going to calculate the Sharpe ratio as the average excess return for the security divided by the standard deviation of the expected return of the security. That's one alternative. Or another alternative could be you take the average return for the security divided by the volatility of return of that security. Those are alternate ways of looking at it. The numbers will be very, very, the differences will be very, very minor, but they are, as I mentioned, not the Sharpe ratio. They are alternate measures, practically very similar. Now, in principle, there is nothing to prevent Sharpe ratio to be calculated for an index either. And so you can do that for our practical, for all those purposes. And so in particular, you can do it for various different market indices. We've talked about the value weighted adjusted return, VWRETD. There's the equal weighted adjusted return, EWRETD. What exactly is the difference between those two? The value weighted return weights, when you're calculating the average return for a particular time period, it averages the returns for the various securities by their market caps, whereas the equal weighted does not. So for instance, we've talked about Apple has 1,000 times the market cap of Navigant. So should the return of Apple be weighted 1,000 times higher than the return of Navigant? That's a question for you to answer, depending on what you're trying to do with it. Okay, if you're talking about an overall return of the market, then absolutely the value weighted is the most important thing to do. On the other hand, Navigant is an investment for you. Apple is another investment for you. If you are just looking at the average investment opportunities, there's a difference, then the equal weighted might make more sense. So depend on what you're trying to do with it. Okay. So the S&P index return is the return on the S&P 500, which is loosely speaking the top 500 firms in the US. That's what we're going to, one of the things that we will consider also. As I have mentioned to you a number of times, the oldest return in the US is the Dow Jones Industrial Average, which loosely speaking is the top 30 firms in public traded firms in the US. So those are the averages you can use. Can you calculate the Sharpe ratio of a particular index? Oh, absolutely, in exactly the same way. You estimate volatility of market returns by the standard deviation of monthly market returns over the relevant period. Then that takes care of the denominator. You take the numerator, which is the average market return minus average risk-free return. Okay, you take the Sharpe ratio, which is the ratio of those two, the average excess return for the market divided by the volatility of return for that particular market index. All right, so let's now go and look at some data. So this here is your Excel work file number 8. Now, one of the things that I have mentioned to you, and I have to mention over and over and over again, is that Excel is not the objective of this course. This is not an Excel course. In fact, I personally find Excel, really a very minor tool in my research and consulting. It doesn't do the kind of work I need it to do. I use it purely, almost exclusively as a teaching tool. I don't think that highly of Excel. It has some properties, it does some things well, but it is really not suited to high level work. So do not think this is an Excel course. The reason we are using Excel is for you to get a sense of working with the data, familiarity with the data, looking at optimization, all right, to understand the finance. The Excel is purely a means to the end of understanding finance. All right, so let's first look at Apple. So over here, as we have done before, we've taken data for Apple from the beginning of 2010 to the middle of 2018. And actually, before I do that, let me quickly go to the raw data. Now, it is absolutely important for all of us to make sure we understand what we are doing. I was appalled, really appalled, to see some of you putting in on the discussion boards where you're simply copying and pasting. You're taking my template, my file, using this as an template and copying and pasting onto it. That really does not achieve any learning. You need to this here is something you need to recreate from scratch. You need to understand these files, figure out what's being done, and go accordingly, okay? Because that's the only way you're going to learn anything. So as we saw from Fred, the Federal Reserve of St. Louis, we take the observation date, which in its infinite wisdom, it reports it as for a particular month. It returns reports the return as that for the first day of the next month. So in order for it to be comparable for our purposes, we need to take that observation date to the previous date, which is the last day of the previous month. Month, year, we extract the month from this previous date, we extract the year, we concatenate the two to get a year month variable, which is the variable. We're creating this variable with the only objective to be able to merge data. One thing, as I have mentioned to you over and over again, and I cannot emphasize enough, stacking two fields against each other is just wrong. I mean, I don't know how else to say to you. It is just wrong. You cannot do it. Later on, when we'll do with daily data, we'll talk about, for instance, US trading data and Brazilian trading data. Thanksgiving is a holiday in the US, so there is no data for that particular trading day. Thanksgiving Day is not a holiday in Brazil, so you will have a trading day. If you just stack them against each other, the data for Thanksgiving in Brazil, that particular day in Brazil, will stack up against a different day in the US. So you cannot do that. You have to merge them appropriately. And that is what we are going to merge here. And so we are creating these common fields purely to enable us to merge data. If you were using a more advanced data processing software like SAS or Stata or R, you wouldn't need to do all of this stuff, because merging is much more straightforward in those data processing software. Well, I mean, for the simple reason that's what they're meant to do. Excel's it's not intended for high-end data work. Okay, but it's very useful to get us started, and that's what you're going to do. Now, if you, for instance, end up going from here to, let's say, Goldman, unless you are working in their equity research area, you will really typically not use SAS or State or R. Excel is what you can, and you can do a lot of things with Excel, especially in visualization, which we will spend a lot of time on. So you need to, this is important to you, especially if you're planning to go to work on Wall Street. And one of the things that my objective is to train you so that you can go to Wall Street, go to Goldman and hit their trading desk, join their trading desk and hit the ground running. All right, so that is going to be my objective throughout this course. So we get the GS1M numbers from Fred, and then we we said, as I said earlier, first you divide it by 100 to get it from a percent to a level, and then divide it by 12 to get it to a monthly rate. In principle, you should do a geometric, but you'll find that it makes practically no difference. So therefore, this is, we'll just use this for our purposes. Over here, just as an example, we have Apple's monthly return data. So we have date, which is reported in crisp as the last day of the last trading day of that particular month. All right. So which is why we need to adjust the FRED data, because the common fields are different, but we need a common field in order to be able to merge the data. So from this date, we extract the month, and we extract the year. We concatenate it just the way we did before. Then we have the Apple returns, which we have downloaded from crisp. And one of the things that I showed you when we downloaded data from crisp is that you can, anytime you're downloading a data for an equity, you can also, you don't have to, you can also download the data for the market, for instance, evaluated return or the return on the S&P 500 or equally weighted returns. All of those you can if you want. So in this particular case, we have done that for Apple. What else do we have? These are the monthly returns for Google. These are the monthly returns for Navigant. These are the monthly returns for Amazon. These are the monthly returns for Walmart. These are the monthly returns for Tesla, and there we are. Let's first try to calculate the Sharpe ratio for Apple. So we have the monthly returns, as we can see on, look at the huge variation in Apple's returns during that particular month, during the first 4 months of 2010. In January, a negative 9% return. In February, positive 7% return. In March, positive 15% return. In April, positive 11% return. I mean, just it varies quite a lot. Whereas, look at the monthly return on the U.S. 1 month maturity debt. It's it's very close to zero throughout. All right, so that's something you will see. We will talk about this quite a lot. It is that's why you see that the monthly returns for 1 month maturity U.S. debt, they tend to be very, very close. In principle, there should be no variation, but well, that's what data are. Data change. Data are not as simple as our theories would like, and which is why we're working with actual data, because theories are great, formulas are great, equations are great, but what do the real data, what is the real world telling us? That's what we'd like to answer, and that's what we're going to do here. So these are the, so over here, as we have done it before, we look up D3. Where are we looking it up from? From the Apple monthly returns. Apple monthly returns. To get the monthly returns for Apple, we have to look at which column we are looking at. So year month, that's column 1. Column 2 is where Apple's returns are. So D3, Apple monthly returns, E1 to F103. 2, that's the second column. And false, it's Excel's unique thing where that's saying we want an exact match, not an approximate match. All right, so this VLOOKUP, once again, what is this VLOOKUP doing? It's doing exactly what would be done in SAS, data, R, Python, etc., as a merging of variables. Because in Excel, this is the way we get our, we create a common field through which we extract data from across different spreadsheets. Similarly, for the monthly returns for US debt with 1 month maturity, what are we going to do? We're going to say, okay, which month do we need data for? That's D3. So we look up D3. Which spreadsheet are we going to look it up from? T-bill monthly returns. What is that common field from which we are for which we are extracting data? That's column E. That's a year-month variable. Column 1, column 2, column 3. So we need to extract data for the third column. So T-bill monthly returns, we take those columns. 3, that's the third column that we have taken, false as in that approximation. Okay, hang on just a second. Once we have a column E as it represents the monthly returns for Apple. F is the monthly returns for US debt. The difference between the two gives you the excess monthly returns for Apple. So it is negative 8.864% in January 2010, and we calculate all the way till June of 2018. Also, the excess return is -1. As you can see, in May 2018, the excess return is 13%. So it's a much more volatile security. So first thing is we need to calculate the average excess return. So here we have the average excess return, average monthly return for Apple is 2.15%. The average monthly return for the 1 month maturity US debt is 0.02%. The excess monthly return, which is of course, it's an average, is a linear concept. It's a subtraction of this minus this gives you this. That is the average, 2.1302%. Medians, minimum, all of that stuff is very interesting. What is the volatility of returns of Apple? It's the standard deviation from E3 to E4, E104 of all these monthly returns. So the volatility of monthly returns for Apple is 7.02%. Look at the standard deviation of monthly returns for the risk-free rate is 0.03, tiny. As I mentioned earlier, in principle, this should be 0, but we are working with actual data, so we won't get 0. All right. So the excess monthly return is not this minus this. Okay, we have talked about this before. Standard deviation does not work in that linear manner. There is it's a quadratic formula, as we have discussed before. It's not linear. So you have to calculate the standard deviation for all this. All right. So now we have the excess. This is the average excess monthly return for Apple. This is the standard deviation of the excess monthly return for Apple. This here is the standard deviation of the actual monthly returns for Apple. So what is our Sharpe ratio? Sharpe ratio, remember, is the average excess return of the security divided by the standard deviation of the actual returns of the security. Let's make sure we get it. Sharpe ratio is average excess return divided by standard deviation of return. There are alternatives for the Sharpe ratio, but the standard Sharpe ratio is this average excess monthly return for Apple divided by the standard deviation of monthly returns for Apple. And so this number here, which is equal to G107, the excess monthly return for Apple, divided by the standard deviation from for Apple. So this number here is 0.30. Does that particular number have an interpretation? Yes. It means for every 1% increase in the volatility, there is a 0.3% increase in excess return for that security. Remember, the Sharpe ratio is the first approximation that you always need to do when you talk about any particular security because of this particular measure, because of this particular interpretation. But there is also a very a deeper interpretation, which is in comparisons across securities. So let's pause for just a few minutes. Okay, so that's that for Apple. Let's now look at Google. All right, just as we did before, let's make sure we have done all the numbers correctly. So January of 2010, Google's monthly return is negative 14%. How do we get that? We look up for D3, go to Google's monthly return data, monthly return spreadsheet. We have created this column E, which is that year dash month. And column F is where the Google returns are. So it's column 1, 2. So it is column 2 that we are going to get the Google data for. So similarly, we have, as we did earlier, we have the monthly returns on US debt. That is, the excess monthly return is simply monthly return minus a monthly return for the security minus the monthly return on the risk-free asset, gives you the excess monthly return for that security for this. So we get these monthly returns for Google for all this period. Look at the average monthly return for Google. Sorry, the average monthly return is 1.5%. The average US debt return is 0.02%. The excess monthly return is the difference, 1.48%. The standard deviation of monthly returns of Google is 6.9%. The excess monthly return standard deviation is 6.9%. But the critical thing is, look at the excess monthly return average is 1.48%, whereas compared to Apple's 2.13%. So Google's monthly return is quite a bit lower. How about volatility? 6.9%, whereas Apple's is 7.02%. Very similar. So already you can see that these two securities have the same volatility, but have different average returns. In particular, Google's average return is lower, significantly lower than the average monthly return for Apple. So, as we said, the first approximation that we will do is to take that Sharpe ratio, which is the numerator being the average excess monthly return for Google, and the denominator is the standard deviation of Google, the volatility. So this ratio is G107 by E112, which is 0.21. Okay, what's the interpretation again? For every 1% increase in volatility, there is a 0.2% increase in excess return. Okay, so that's the interpretation. But the comparison is now interesting, that Apple's Sharpe ratio is 0.30, whereas Google's Sharpe ratio for this time period is 0.21. Okay, so you can see that from this first approximation, that's not the only thing. We'll see later there is much more to it than that, Google's Sharpe ratio is significantly lower than Apple's Sharpe ratio, which means on this first approximation, Apple is a better investment than Google. How about Navigant? We do exactly the same calculations all over again, and we find that the average excess monthly return for Navigant is 0.77%. Interesting. Compared to Google's 1.48%. Google's almost double. And Apple's 2.1, almost triple. Okay. So Navigant has significantly lower, quite a bit lower average returns, average excess returns. But whoa, look at the volatility. Its volatility is 9% compared to Google's 6.9% compared to Apple's 7.02%. So Navigant not only has quite a bit lower return, it actually has a higher volatility. So it is a horrible investment, absolutely horrible investment that you can see right away. So, okay. So once again, at the first approximation, you can see if you take the average excess monthly return, 0.77%, divided by the standard deviation of the monthly returns for Navigant, it's 0.08. compared to Google's 0.21, compared to Apple's 0.3. Okay, so the first approximation immediately tells you that while Apple and Google are clearly relatively good investments, there are not all investments are good. All right, there is it's just one of those things. So remember we talked about this earlier, diversification. You can put a bunch of securities together, you can reduce the risk. That doesn't mean it's an overall good investment. All right, so because there are many more. And flip side is, for instance, some of you pointed out that Alibaba had lower monthly returns than some other securities. That's a good data point. That doesn't mean Alibaba was a better investment, okay? Because a better investment needs much more nuance. And also an investment, you cannot think of an investment as its own being. You cannot think of it as an island. It is in the context of a portfolio. So what we will do later is talk about optimal portfolios. All right, it's just does not make sense to say, is Apple a good investment without context because of the covariances that we have talked about. Okay, so for instance, so since this has come up, let's just make sure we are on board with it. Apple's covariance with T-bill is tiny, as you would expect, but later on we'll talk about some other more interesting covariances. Tesla is, of course, a far different stock. Okay, look at its excess monthly return. It's almost 4%. Okay, so it's double Google's average monthly return. It's almost 3 times Apple's monthly return. Yeah, and over 4 times Navigant's average monthly return. In fact, later on we'll see that if you had bought Tesla on its first day of trading, your money would be worth 13 times as much. I mean, huge returns. But as we'll see later as well, it's an extremely volatile stock. 16.00, 16%. So it's even almost double that of Navigant stock, right? So it is substantially higher returns, but also substantially higher volatility. They don't necessarily go together. Okay, so please don't make a statement like, oh, all these returns, so therefore higher volatility. They don't necessarily go together. In principle, however, an investor will only take excess risk if they're compensated for it. So there is that risk return trade-off, and an investor will typically have is compensated for the risk the investor takes. So that's part of it, but you cannot just make those kinds of statements. So what is then the Sharpe ratio for Tesla? It is the average excess monthly return, 3.89%, divided by the standard deviation, which is now the Sharpe ratio is 0.24. What does it mean? For every 1% increase in volatility, Tesla security provides 0.24% increase in the average excess return. Okay, 0.2433, which is higher than Google, lower than Apple, but of course, still substantially more than Navigant. So those are just 4 securities we've looked at. How about for the market? So we do exactly the same way as before. However, when we get the monthly return for the security, how we have to look it up for D3 once again, and we go to Apple's monthly return, because that's where we have downloaded it, and we say, okay, for the S&P 500 return, this column E is that common column against which we're measuring everything. 1, 2, 3, 4. So it's the 4th column that you are measuring. So let's go back to S&P 500. The monthly return is VLOOKUP D3 Apple monthly returns. The columns E through H, 4th column, and false to say that it's an exact approximation. Monthly return, as we did earlier, the excess monthly return is the monthly return for S&P 500 minus the monthly return on US debt of this similar maturity, that gives you the excess monthly return for the S&P 500 index. What is the average excess monthly return for the S&P 500 index, which remember is an index of the whole market, which is loosely speaking the top 500 firms in the market. Okay, so that average excess return is 0.91, which is significantly lower than the corresponding figure for Google and significantly lower than the corresponding figure for Apple. It is higher than the excess monthly return for Navigant, which tells you that if you were to just broadly invest your money, your average excess returns would be significantly higher than Navigant, but lower than Google or Apple. What is the standard deviation? What is the volatility of the S&P 500 index? That is 3.4, which is quite a bit lower than Google's 6.94 or Apple's 7%. And that's what we would typically observe with markets is that they tend to have the average excess return tends to be smaller and the volatility tends to be smaller. Once again, the risk return trade-off, that's what we observe. But that by itself is not an a priori requirement. So what is the Sharpe ratio then? For the period under consideration, 2010 January to 2018 midway, is the ratio between 0.91% divided by the standard deviation is 0.27, which is again quite a bit higher than Navigant, but between Google and Apple. All right. So on this first approximation, investment in the S&P 500 is lower return than Google or Apple, but also lower volatility than Google or Apple. Okay, how exactly do you trade them off? And that's where the first approximation is always the ratio, the Sharpe ratio, and that turns out to be 0.27%. The Sharpe ratio can also be used to compare across time periods. Yeah, so we say, okay, 2010 to mid of 2016, that number is 0.27. But what is it during President Trump's presidency during this time period? We do exactly the same calculations of excess monthly return for the S&P 500 divided by the standard deviation of monthly returns on the S&P 500 index, and that number turns out to be 0.49%. I'm not, I'm too much of a financial economist to claim that this is due to President Trump. All I'm saying is that that sub period where President Trump was the president of the country, the market had a better Sharpe ratio than if you take the entire time period. Right? So these are the kinds of things you need to do. You need to cut and slice and dice the data in different ways to get a sense for whether there are differences in Sharpe ratios across time periods and comparisons and so on. All right. But later on, when we do market efficiency, we'll also see that Walmart turns out to have become quite a different firm over the last few years because of its move to significantly more e-commerce than it used to be.